Good afternoon, Intermark Global World. We are back again for series 5 of our podcast series. I am very kindly joined by Mark today. Thank you very much for coming, Mark.
Thanks for having me.
Fantastic. As I always like to do, I'd like you to introduce yourself. If you can just kind of give me a bit about yourself, about your company, and we can take it from there.
Yeah, definitely. So my name's Mark. Obviously, I'm a mortgage consultant. Yep. So I've been a mortgage consultant now for just over 8 years. Primarily, obviously, based in the UK. Recently came out here to help sort of buyers over here buy into the UK. So our company is called Capricorn International. So just give you a little bit of a background about them. Capricorn are primarily a UK-based mortgage broker. Our office in London is the highest performing mortgage broker office in London.
Fantastic.
Based on sort of volume of business that we get, etc., etc. I think there's 1,800, 1,900 5-star reviews now as well. So we're well trusted as well in the industry. And we are now one of the biggest international mortgage brokers as well, helping people from all over the world, buy investment property or residential property in the UK. Hopefully that just gives you a little bit of a sort of a flavour as to who we are. Whole of market access and so on and so forth. So hopefully we can help you whatever your circumstances are.
Okay, fantastic. In that regard then, so I think the burning question I get from a lot of my clients is, firstly, as an expat or as a non-resident, can I get a mortgage in the UK?
Yeah, definitely. I say that. So in theory, most people will be able to get a mortgage in the UK.
Okay.
If you're an expat, you have more options. If you're just a flat foreign national that wanting to buy, then you still have plenty of options. Mm-hmm. But mortgages are very personal.
Yeah.
So it all does depend on your circumstances, what your income is, what you're doing, exactly where in the world you live. It is entirely possible. But I would say as long as you're not living in like a war-torn country, then there's probably going to be an option there for you somewhere.
Fantastic.
Yeah, definitely.
Okay. And I'm very much an advocate of mortgages. Can we talk about, first of all, why people would look to purchase with mortgage? So in this region, what I find a lot is, Stephen, I have 300k cash. I want to buy cash. And I turn around to my clients and say, how would you like to buy 3 properties with that £300,000? And they say, Stephen, how? And then I often say, well, phone Mark and find out. Could you talk a bit more about that conversation that you had with them and why leveraging, especially in the UK, more than I would say in most countries, is really, really beneficial, especially for investors?
Yeah, I think, to be fair, you've hit the nail on the head there. It's about diversifying the income, diversifying your portfolio, and just maximising what you can do with that income. I think it is really easy to, just plough £300,000 into a property, buy it cash. It makes the whole process seem easier. I'm just buying it in cash, right? Mm-hmm. But ultimately, it's actually how can you use that £300,000 for the best. Yeah. And actually, if you can get sort of 2 or 3 or sometimes even 4 properties, depending on where you buy, you've got all of those properties then growing in value. You've also then got, if one property is untenanted for X amount period of time, you've potentially got the other 2 or 3 that are sort of helping to cover that. Financing properties also does have certain tax benefits as well. So you can offset your mortgage payments and fees and stuff like that, obviously against your tax at the end of the year. Mm-hmm. And capital gains tax as well is another big one as well, because you don't technically own that portion of the property. So so it comes against your capital gains tax at the end of the year. So I would say most people will purchase with a mortgage, mm-hmm. And they'll typically go somewhere between 50 and 75%, just because it's a better way of making your money for you. Why tie it all up in one property when you can have multiple properties or multiple different investments, not necessarily just in property?
Fantastic. I think you answered probably my next question is, a lot of people, there's a stigma when it comes to mortgages, and it's, I don't want any debt.
Yeah.
And when I hate to sound like I'm reading an extract from Rich Dad Poor Dad, liabilities versus kind of your investments, but when we're talking about debt, especially if you change that word to leveraging and it's used properly, then I would then see the real benefits of how you can use putting down a smaller of amount. And you talked about there 75 or 50%. Can we talk a bit about how much on average that you have to put down for a property and how much you can mortgage? And then maybe what the refinancing process is, because I think a lot of people don't really understand why purchasing with a mortgage could be so lucrative.
Yeah, no, definitely. Okay, so yeah, a couple of points to sort of cover off there then. So, I think the term leverage sounds a lot better than debt. Obviously, debt is a horrible word, isn't it? It's, oh God, I'm in debt. But yeah, leverage is a much better word. And like I say, it's, you're leveraging your savings or your income or your investments to the maximum potential. That's, it's a much better way of phrasing it for a start. From a deposit perspective, in an ideal world, you want to be putting down 25%.
Is that the average that you
It
tend
is
to
the
see?
average. Yeah, it is the average. There are certain lenders that might go higher than that. So we do have certain lenders that might go to 80% or 85%. So there are sort of potentially different options. But it then becomes, it's a lot more risky for the lenders there. Rates start to become a lot more expensive. How feasible is it? So on and so forth. So they're kind of all different things you have to factor in. But again, personal circumstance dependent, obviously. But yeah, a typical would be 75%. Some people, if you are in sort of more obscure countries, then lenders will potentially require that you put down 45 or 50%. So it is all, like I say, it is all dependent. Yeah, and it's relative as to where you are and what the lender's risk appetite is. Okay. But like you say, if you're buying a property of £300,000 and you only have to put down 150 and you've got another 150 to play with somewhere else,
there's a lot more you can do with that money.
Yeah, there's a lot more you can do with that money.
Yeah. And in terms of the mortgages now, one thing that I often get frequently asked question is, Stephen, so I want to buy a buy-to-let property. I want to put down 5%. And the common misconception is a capital repayment mortgage is the same as an interest-only mortgage. Yeah. And I'm probably talking a lot of property jargon to people here. So can you help expand on what is the difference between mortgages in the UK?
Yeah, definitely. So I think one of the biggest differences, obviously, like between us here in Dubai and England is typically, from what I understand, if you buy a property over here or you finance property over here, you can pretty much use that property for whatever purpose you want. Yeah. It doesn't work like that in the UK, and obviously trying to tell people about that and inform them about that can sometimes get a little bit confusing. So in the UK, you have to finance the property for the means of which you're going to use it. Okay. So if you want to use it as an investment and have long-term tenants in there, then that's one way of financing it. If you want to finance it as a holiday let, so short-term lettings, Airbnbs, so you can use it as well in summer months or whatever, then that's another way of financing it. If you want to finance it for your family to live in, again, it's quite common for people to want to invest in the UK for their children to live while they're in university. Is quite a common one that we get. Then that's a residential mortgage. So, and all three scenarios are assessed differently. Yeah. And then you have the choice of, do you put it on capital repayment or do you put it on interest only? So to literally break it down in its simplest form, a capital repayment mortgage is where you pay the interest and you pay the principal loan amount. So if you was to take a capital repayment mortgage over 25 years, when you come to the end of that 25 years, your property is going to be mortgage free because you've paid it all off. If you take a mortgage on interest only, then you are only paying the interest. So the capital balance will remain outstanding. So again, comes to 10, 25 years, you still owe the £150,000, in the examples that we've been using. So, but you can make overpayments. Okay. And I think that's quite important to know. So a lot of people will take interest only over capital repayment because it gives them more free income because they're not having to commit as much of a monthly payment, especially if the property is untenanted or there's, I don't know, the boiler goes wrong or something like that. You've got more spare capital to reinvest into the property in that way. But then at the end of the year or every 6 months, or if you get a bonus from your employer or something like that, you can just approach the lender and just say, look, I've got an extra £10,000 or 20,000 or 30,000, can I just pay this off the mortgage? And you can, typically speaking. So, and that will come straight off the capital balance and instantly reduce the amount of interest that you pay. Instantly reduce the amount of interest that you pay. So that is a really good way of doing it. And it also puts you in control of when and how you pay that mortgage off, rather than to be committed, if that makes sense.
So you don't have to really see that term out. If you want to go early, you can potentially go early
by 100%.
making overpayments.
Yeah, 100%. So, it does depend on lender to lender. Typically speaking, most lenders will allow a 10% overpayment facility without incurring any charges.
Annually?
Yeah, annually.
Okay.
Yeah, so annually they'll typically allow a 10%. Some lenders have slightly different rules on that. But yeah, you kind of get the idea, and you can reduce the mortgage quite quickly in that way.
I know a lot of this conversation today is going to be quite broad stroke in the sense that with mortgages, as you suggested, they are quite subjective to each client's criteria and needs.
Definitely.
Hence why definitely get in contact with Mark if you want some personalised advice. But in saying that, now we talked a lot about investment. Let's talk about homeowners, because I've got a lot of first-time buyers and homeowner friends. If I'm a first-time buyer in the UK and I'm looking to purchase with a mortgage, first of all, is it possible for me to get a 5% mortgage? Is it possible for me to get a 10% mortgage? Also as well, how does it work in terms of my income? Is it like, from my understanding, it's 5 times your income, some are 4. What is the differences and how does that work?
Yeah, definitely. So if as long as you're in Britain and you're British passport and whatever, or indefinite leave to remain, those type of circumstances, then you can get 95% mortgages. There is 1 or 2 products where you can actually get 100% mortgages as well. But
that come out recently, didn't it? I saw.
So they've been around for quite some time.
Okay.
But the way the products work are all different.
Okay.
So some products just want you to be able to demonstrate proof of proof that you've been paying your rental payments for the last 12 months. Obviously your credit's got to be as clean can be. And there's other products out there which will give you 100%, but they might want to take an equity stake in a parent's property or something like that. So there are ways to do it without deposits. But yeah, most first-time buyers will have a 5% deposit. Some will stretch to a 10%. Again, if your credit history is a little bit shady, then you might need to have a bit more of a deposit. And then as far as your affordability goes, a general rule of thumb is typically around sort of 4.5% to 5%. Depending on the line of work that you're in, depending on, if you're an accountant or a teacher or a doctor, some lenders will take the view that your income is inevitably going to be increasing either annually or just with experience. So they might lend you more money based on that. But then you've also got to factor in, have you got a car payment? Have you got children? Are you paying a student loan? All the expenses.
Yeah.
So sometimes that can have a knock-on effect as well as to how much you're going to achieve. But like I say, there's 90 odd lenders in the market. So to categorically say, no, you can borrow this, no broker can tell you that unless they can, unless you're prepared to go through that information. And then let us do that research for you. But yeah, about 4 to 5 times is fairly standard.
Fantastic. And maybe broader and moving away from mortgages, which we will circle back to, just in terms of property, what are your thoughts on property as an asset class? Why have you chosen it as an asset class that kind of to work in? And what are the benefits, what are the pros, what are the cons?
Yeah, very, very good question. I think property personally is a great investment. One, because if you're buying it for your own, yourself to live in, then by the time you come to retirement, you've got a property there which you can. You're not paying rent on it. You've just got your bills to pay and so on and so forth, and it gives you, security in that regard, rather than sort of having to float here, there, and everywhere. From an investment perspective, if you're looking at the UK in general, house prices have steadily increased, since the dawn of time, effectively. And that has continued to be the case. Yes, there's dips, but they're not massively volatile.
Yeah.
And even now, even with sort of the COVID, the high base rate and so on and so forth, house prices are still predicting to increase, with demand and such that's going on. So, so from a UK perspective, it's just a safe asset, isn't it? You've got that, old saying, haven't you, sort of safety in bricks and mortar, haven't you, I think. And that's the way to look at it. But if you are going to look at it, it's got to be a long-term investment. And if you're looking at it from a buy-to-let perspective, I would say in the back of your head, you need to be looking at sort of 10 years plus investment to really maximize your profit, especially as an overseas investor, stamp duty and so on and so forth. But if you're looking for really quick returns, is property really the right option for you? That's a question that you might need to ask. But 10 years plus, I think it's a great investment plan.
Fantastic point. A point where I'm going to play devil advocate on. Reason why I say that is, so I'm very much in the school of thought that you are. So I see property as a long-term asset. All of my investments are long-term. How we are telling our clients to invest are long-term. However, we do have clients that like to flip. So clients that like to, and this is actually kind of away from the mortgage questions that I was asking. Buy off plan, sell off plan. Or secondary, buy, renovate, refinance, and potentially sell or potentially hold. That's maybe a 2-point faceted question. What are your thoughts on those strategies?
Again, and you're quite right in what you're saying there, to be fair. I mean, if you're buying a property off plan, depending on where you're going to buy it, if you're going to buy it, it's got like a 2-year lead on it, for argument's sake, for completion, especially in London. You might find actually, you might buy it today for X amount of pounds, and actually in 2 years' time, it's now worth,
40, 50 grand more.
40, 50 grand more. So you've made quite a nice little investment there, and if you can flip that on the side, then great. And throughout that time, it's barely cost you anything, has it? So, again, it's a good strategy if that's what you want to go for. The buying, renovating, flipping, again, also can be a good strategy, if that's what you want to do. And I've helped a lot of people do that. And there's ways that you can finance that as well. There's bridging finance, asset finance, and so on and so forth that can help you to do that. And so, they are good options. They are very good options.
I'm going to ask what the audience is going to ask. What is bridging finance? What is asset finance?
Right. So bridging finance is typically short-term finance. Okay. So most bridging finance will typically have a maximum term of up to a year. Yeah. You'll pay your interest monthly, same as you would do anything, but there's no exit penalties on it. So. Most commonly, people might use bridging finance to buy a property that is, quite literally unmortgageable. It's uninhabitable. It doesn't have running water. It doesn't have a bathroom or something like that. It can't be lived in its current state. So it's unmortgageable. So some people will take bridging finance on that to get those renovations completed. That might take them 2, 3, 4, 5 months. And as soon as that's completed, they'll refinance off of that bridge. They'll take the maximum amount of equity they can out of that property, and they'll put it onto a standard investment mortgage. Yeah. So it really is just short-term lettings.
Bridge that gap.
To bridge that gap. Yeah. Another common option for that is auction properties. Okay. So if people are buying at auction, you might have. Some auctions, go as short as of a 14-day turnaround for completion. Like they're quick. You're never going to get a mortgage in that time, especially if something goes wrong. Then you really poop. So, bridging finance is a really quick way of turning that around as well. And then pretty much day one, as soon as you've bought and you've completed, you can look to refinance it again. So it can literally be that quick. Asset finance. I know. Let's just say you've got capital in the bank, which you just don't want to put down into the property, or you own some expensive artwork, or you've got watches, or fancy car, or a boat, or something like that. Then you can actually lend against those assets as well. So that is another way of potentially doing it as well. So I actually had this question the other day from sort of one of our clients, and we were discussing this with a bank that we work with. And actually, there's the potential to lend X amount of money against one of the properties they currently owned, and X amount of money against just the capital savings he had in the bank. The borrowing between both of those actually allowed him to, or could potentially allow him to buy the property at 100% without having to put down any physical deposits, just borrowing against his assets and what he currently has. So, mortgages can be very creative, but like I say, personal circumstances dependent.
And in that, let me give you a scenario, because I actually had a client like this quite recently. Very wealthy client, doesn't live in the UK, but is of the age of, in the UK, what would consider retirement. So in terms of his mortgageability, and maybe that's, again, a two-faceted question. So why is it that lenders do not tend to like people, or not, I won't say don't tend to like, but find it harder to lend to people that are kind of closer to retirement age? And how potentially could asset finance be a way to circumvent that?
Right, so... if you're buying a property for an investment purpose, age doesn't really matter. Okay. There are certain lenders, of course, there's always lenders that will sit there and say, no, we're not going to lend beyond the age of 70 or 60 or, your stated retirement age. But when it comes to the investment properties, a lot more lenders sit there and just go, we don't really care how old you are. I think the longest term mortgage I did took someone to about their 118th birthday. Okay, so age in that regard doesn't really matter. When it comes to residential mortgage and buying it from a residential purpose, then again, age can become a factor, and a lot of lenders will stop at retirement. But if your retirement income is okay, then again, there are lenders that will go to age 90 or 100, on residential mortgages. Personal circumstances dependent. Okay, caveat that with everything that I say.
Course, yeah.
But there are ways around it. But if you find that actually for whatever reason your circumstances don't cater you for that, but again you have got the assets because you're a high net worth client or whatever the case is, then use the assets, finance against the assets. It's just about having conversations. But what I would say to people is the more information you give us, the more options that's going to allow us to present to you.
Fantastic. And again, with the caveat of everything being very, very subjective to personal circumstances, let's just say estate planning. We are looking to, someone's passed away, they want to pass on their property. Does that mortgage pass on as well? Or do you then have to get another mortgage?
Very good question. So the mortgage doesn't necessarily pass on. The mortgage is underwritten for that particular person. But effectively, kind of like almost a pause gets put on that property while it goes through probate. Okay. So, but the lender will be sitting there going, when am I going to get my money back?
Sorry, but what is probate? Could we just...
Oh, sorry. So go back. So, when you pass away, your estate goes into effectively probate, which is the legal stage where everything is getting decided as to where it's going to go. It's getting processed. It's getting name changed. It's doing whatever it's doing, before it exits probate, and then obviously it transfers to wherever it needs to transfer to. So probate is just kind of that legal... That period. Yeah, that legal bubble in the middle. So you might see that come up quite a lot if you're buying a property, but it might be, a probate property for argument's sake. That's a whole different conversation to have. I've lost where I was now. So
if it goes over to the next person?
Yeah, so sorry. So when it goes over to the next person, that person will either have to find a way of refinancing the property or paying it off. Okay. They're basically your two options there. Depending on how how the other person owned it, you might have inheritance tax to pay, so that's got to be something to factor in as well. So there are certain questions and conversations you've got to be had. But typically speaking, the lender's going to want their money back, and they're going to have to try and find ways of refinancing it.
Fantastic. Let's talk a bit about Dubai. So I know you've made a jump over across the pond to the sandpit.
Yeah.
How are you finding it, first of all?
I really like it. It's a big change. It's a big obviously a lot hotter. Certainly not as cold. I think all my family in the UK at the moment are moaning that it's like 2 degrees or something awful. But yeah, no, I really like it. I think the culture over here is really nice. People seem really nice. Everyone's receptive to everything. Everyone's happy to have a conversation with someone. You just need to speak to people. And I think that's really good. And I think one of the biggest adjustments I've had over here is kind of just how safe everything feels. I think that's probably one of the biggest differences I've seen. It's just really secure, and obviously it's really nice. Get to go to the beach every weekend and swim in the sea, so it's great.
I definitely second that. And how do you feel in terms of, let's talk now expats. So a lot of your business is going to be with expats, so expatriates of the UK. It doesn't have to be the UK, it could be other countries, but let's just talk about the UK specifically. In terms of expats, there is a number that I know off the top of the head, and it's 60% of expats that come to Dubai especially leave with less savings than they arrive with. How could potentially investing in property help build wealth?
Okay, great question. I think it's, you're building your asset pool, aren't you? I think it's very easy when money's in the bank just to spend it. And that doesn't matter where it is. It could be in savings or whatever. If you can access that money, it takes a lot of discipline to just leave it there. Whereas I think if you invest it into property, in many respects, it does actually become a lot more difficult to get it out. But I think you tend to just invest with the property again with that longer term goal that we sort of had in mind. And I think, from an expat perspective as well, it's, if you're investing back into the UK or you're investing back into your home country, it kind of psychologically just gives you those roots back home. And it's kind of like, okay, that's safe, and like I say, if if it doesn't work out overseas for whatever reason, and you do want to go back, then your asset is there. I don't really know what more you can say on that, to be fair.
100%. And being in Dubai, I know that you're new here, but what do you feel in terms of kind of, we have a question all the time, should I invest in Dubai, should I invest in UK? And you've spoken on it, UK is safe. What do you think about the Dubai market in terms of property?
That's a really good question. Really good question. They're two different beasts, aren't they? Yeah. They are completely different. In the way they work, the yields, obviously the taxes over here are obviously a lot more attractive because there aren't any. Yeah. So I can see the appeal over here. My knowledge of the market over here is a lot more limited. I understand though that prices here are a lot more volatile and they fluctuate quite a lot. I've sort of heard from speaking to certain people that actually people are still recovering from the 2008 crash over here. Yeah, 100%. So I've heard that's still quite a big thing. Whereas in the UK, that kind of people recovered from that quite a long time ago. So they're two completely different things. But to be honest, I don't know enough about the market over here to comment. Would I invest over here? Yeah, totally, 100%. I think it's fairly sound. I think you can get a lot for your money over here. Rental demand again is good and is strong, with the sheer amount of people coming over here. I think over here is a good investment. But longevity, I probably would still invest in the UK personally.
Fantastic. And just maybe my own personal insights, kind of Dubai versus the UK. I'm going to kind of second what you said there. I think with the UK, I was asked in our first podcast, why invest in the UK over Dubai? And I said two things. I said safety and stability, and also history. Yeah. If you look at the UK market, and it's a number that I bang on about a lot, over the last 70 years, we've seen 364% of growth in the market, inclusive of inflation. We've seen a lot of socio-economic changes. We have seen legislation changes that actually happened quite recently again. Yep. We had a budget a couple of years ago with Theresa. We've had another budget, and things have changed. But one thing that doesn't change is the appetite for the UK market. It's an international market. It's safe. Safe as bricks and mortar, if you want to say. Yeah. It's a tangible asset. And we are chronically undersupplied in the UK. unfortunately, the government aren't able to keep up with the housing that needs to be built. So therefore, there's a chronic undersupply of property, therefore chronic demand. So it kind of leads into rental income being higher,
Yep.
rental demand being higher, and capital growth being higher. So when people talk about Dubai and to look at that as a divide, Dubai, I would say, has been a market that we probably look at for the past 20 years. And in those 20 years, we have seen 7-year cycles. So we had the first 7 years when we had the '08 crash. 7 years on from then, 2014, we saw a bit of a dip in the market because that happened because a lot of the people that came to Dubai were expats. And I think a very large percentage in the UAE are still expats in general, especially in Dubai as well. And if they don't stay here, then where is the market for it? But Dubai is heavily invested in tourism. We have a big serviced accommodation market out here, and people like to do your Airbnbs, etc. And kind of years on from that, we saw COVID happen, and a lot of people went back home because if you're going to be locked down, at least let me be locked down around my family was the sentiment. So to bring it all back in and to kind of maybe summarize it, I think, as you've said, the long-term aspect of the UK is great, but if you can diversify your portfolio and have Dubai as well, that is fantastic.
I think that potentially actually just comes back to one of our earlier points about leveraging as well. Like, if you've got 300 grand, why can't you buy in both countries? Why put all your money in one place, buy a place over here, buy a place in the UK?
100%. And maybe moving away from property now, just because I've said the word, it kind of sprung to mind, diversification. We're not giving financial advice here. We're just talking about things that we know. But in terms of diversification, property being one asset class, is that something that you see with a lot of clients? Do they just invest in property, or do you see them invest across different asset classes, be it stocks, be it crypto, etc.?
It depends on the wealth of the client, to be fair. You get a lot of, sort of your high net worth clients, and they will diversify all over the place because they understand that actually diversification, again, is safety. Yes, you can put your money in properties here, there, and everywhere, but it's still all in property. It's still one asset class. Whereas if you've got your money in stocks and shares, you've got your money in gold, you've got your money in, I don't know, Rolexes and watches, or whatever you've bought. I think diversifying the income is definitely important. I think, sort of a lot of, I don't want to use the term average because I can't think of another word right now. But your people that aren't necessarily high net worth, I think they will try and just invest into property because they see it as a nice boost to their income. It's immediate. They can, you can see what you've bought. It's physical. It's there. You can see the property growth. You have something to manage and deal with, and you can see the income getting paid to you month after month. So I think it just depends on the person that you are. I've personally dealt with clients in the past that have 50, 60 plus properties in the UK.
Wow.
Really big portfolios, and they're generating, serious income, from that portfolio. But on the flip side of that, quite a lot of people are just happy with the one. I'm just going to buy the one property. Over the next 20 years, I'll gradually pay the mortgage off with the rent. So that actually by the time I come to retire, I've potentially got a house worth a couple of £100,000 that I can sell. That's another quite common thing as well is, can I just use it for my pension later on? Well, of course you can. So it's again, personal circumstance dependent, but I think if you can, diversification is definitely the way forward. But if you really want to take property as a sort of a business and to, replace your income, then again, that's certainly achievable. And I've seen it done over and over again.
Fantastic. And kind of when we look at that then, and something that you touched on there. So something that I often say is, I say to clients, and they really like when I say this is, you've got £100,000 in the bank and you don't know it. And they go, Stephen, how do I have £100,000? And I tell them something called refinancing and remortgaging. Can you talk a bit about refinancing, remortgaging, and how we can release equity?
Yeah, definitely. So if you've got a property that's just sat there with no mortgage on it, so it's unencumbered, you want to go out and buy another one, or you just want to, you want to pay for a wedding, or you want to, invest it somewhere else, whatever you want to do with that money, then yeah, you should certainly consider the property which you currently own. Some people will buy properties in cash just from the start because it's easier for the transactions. Like we said before, certain auctions and stuff like that will typically want it done quite quickly, so they'll buy it in cash. But you can release money from a property effectively day one of ownership. So that can be a nice, powerful tool to have, in your arsenal. But yeah, if you've got, like say, that property that's worth 200,000, you've potentially got 150 grand there, 75%, potentially more, that you can release that you've probably forgotten about, or whatever the case is. And like I say, with that £150,000, that's potentially another 2-3 properties you've got there, or another one property, and 70+ thousand pounds to go towards other things. So it's definitely worth consideration. From a process perspective, it doesn't work that much different to buying a property from a finance purpose. So you're still going to apply for the mortgage, still going to find the rate that suits you, the product. You're still going to need conveyances to sort out the legals and the title deeds of it. So for all of that to go through, could be as short as 2 or 3 weeks. Or it could take a couple of months. Again, it just depends on how the process takes. But you can potentially release that money quite quickly to invest into other things. And it just depends on what you want to use it for as to what lender you go for.
Is that money taxable?
What, that you release?
Yeah.
No.
Tax free.
Yeah.
Fantastic. Okay, so I'm going to give you a scenario, and it's a common scenario a lot of my clients. So I have a client, let's just say for argument's sake, they bought an apartment in Manchester off plan. They bought it 2 years off plan. They bought it for 300k. When that property completed, it was worth 350,000.
Yeah.
They got a fixed term mortgage, interest only, and they got a fixed term for 5 years. Let's just say at a rate of 5%. After 5 years, that property that they bought for 300,000, and I'm going for easy maths here, I'm just going to say it grew to 450. So it's gone up 100 grand, 150 grand, sorry. Yep. So 150 grand over that 5 year period. It's actually 7 years because it was 2 years off plan when it was initially bought. They want to refinance on that property and take out cash. They've come to you, Mark. What happens then?
Yeah, so again, you can potentially release back up to 75, 85% of the property value, to which you can obviously then take out. So you pay off the existing mortgage, take the new one, release the capital, that goes straight into your bank account. Again, the process is really simple, so it's just the same as what I said before. You still need conveyances in place to sort of do that. Depending on where you're located, if you're actually located in the UK, some actually lenders will do that process for free for you, actually offer that process for free. And again, it just takes a matter of weeks to do it. But again, that's quite a common thing. So, for people that like to finance a property and sort of have that mindset of, leveraging it is better than not. Some people would just sit there and just say, okay, well, great, I've made 150 grand. That's lowered my loan to value. That's going to be my interest rates are slightly cheaper now, maybe. And they'll just take that and, they're generating more income from it that way. But yeah, if you want to release the funds, then yes, you can do. Like I say, in that particular example, you've got potentially 100 grand there, which you could take out and buy another property with, or again, invest it elsewhere and diversify it. So definitely worth consideration.
Fantastic. That's the conversation I usually have with my clients. As we said, in that example, we take out 100 grand, we reinvest that cash. We've essentially turned 1 into 2, 2 into 4, and it's how you go and play Monopoly in the big smoke.
Yeah.
But no, great. I think one thing that I actually found out when I joined property, and I didn't know this before, is you can get one mortgage across your whole portfolio. So instead of having multiple mortgages, let's just say I'm a high net worth client, I have 3 properties, and each of them are different rate mortgages. I understand that you can consolidate all of those mortgages into one, and potentially because of that consolidation, you could be in access to better rates.
So not every lender will do that. That's quite crucial. It's not a common thing for every lender to offer that kind of service. But there are lenders out there which will do that. Yeah, exactly. So, if you've got multiple properties, then is it easy just to have it all managed by one monthly payment, one application, one bank, so on and so forth? Definitely doable. The lenders that sort of offer those deals, they do range from your high street names to your pure mortgage finance companies. But they are definitely available, and worth consideration for sure, especially if you've sort of like own one already and you're buying another one simultaneously. Then actually, is it better to consolidate them all under one roof? Definitely an option for sure.
Fantastic. And something that you just mentioned there, what's the difference between kind of high street lenders, your normal banks, to kind of other lenders and maybe even buy-to-let specialist lenders?
Yeah, so I sort of say that term, I suppose, in the sense of when we think of high street lenders, we think of big names like HSBC, Barclays, Nationwide. They're your high street banks, which you see every day.
Yeah.
But there's banks and building societies that people don't necessarily think of, especially in the buy-to-let space. So you've got people like Precise Mortgages, Fleet Mortgages, Molo, that aren't on the high street, that aren't available for customers to go to directly. They have to go through brokers for, so they don't know about these people. So when I say sort of pure finance, it's those additional added extras that you kind of have that aren't on the high street. And both have their perks. Both will do different things. Some banks and stuff will do stuff that's a little bit more obscure, but typically, they're more vanilla lending, they're more vanilla portfolio landlords, and so on and so forth. Whereas your people like your Precise, your Fleets, your Molos, they are looking at the property for what it is. They'll do sort of like large HMOs, houses multiple occupancies. Yeah. They'll potentially do entire buildings with multiple separate flats in them as well. So they'll typically do your holiday lets and stuff. There's a massive pool of lenders out there which people just don't know exist. And sometimes the building societies, well, people don't think about the building societies, especially if they're not in your town.
100%.
So, if you're from, I don't know, central London, and I quoted you, I can get you this rate with Staffordshire Railway Building Society. Would you ever have thought that was even a thing? Probably not. But actually, they offer a great product. So I think that's one of the good things about using a broker as well is it is very easy to default to your bank because you think they're a bank, they're going to offer you the best rate. But actually, are they best for your circumstances? Maybe not. So it's always worth just having that conversation with someone that is in the market just to gauge if you are actually getting the best deal for your circumstances.
Oh, fantastic. And as a broker, typically people aren't really educated on kind of how brokering works and how it works as a mortgage. Can you just explain a bit about your role as a broker, how you help your clients? I know you've touched on it there, but if we could just elaborate on that bit, and why it would be beneficial for someone to use a mortgage broker in any sense, residential, commercial, or residential buy-to-let.
Yeah, it's a really good question, and I think it comes down to we're professionals in our field, right? Same as you are in yours. You'll help people source property because you know it, you know the areas, you know what's going to give them best yields or whatever the case is. So people are sort of relying on that that experience to get them where they want to be. I think using a broker is a really powerful asset to have because, like I say, we do have access to whole of market. We will take that holistic view. And if one lender says no for whatever reason, the chances are before we've come back to you, we're actually coming back to you with an alternative solution rather than just saying, we said no, now off you go. Yeah. It's unfortunately they said no, but actually we're now going to try this.
So working on behalf of the client.
Exactly. Yeah. So, and we are here to get people, the best deal for their circumstances. So, that's quite an important thing as well. And I think some people can get sucked in to just go compare or whatever the case is. They'll see a headline rate and they'll be like, I want that one. But actually you might not be entitled to that rate. Yeah. And that's where sort of we come in to actually explain that process and sort of help people through it. And we don't just help with the mortgages as well. Like we will help with, if you've got questions about a property or if you've got questions about the buying process or if you have, questions about the conveyancing or, what happens next? Well, do I buy it in a limited company? Do I buy it in personal names? we can help you with those decisions and help you through that. I've personally helped buyers make offers on properties. I've helped them secure better deals. I've spent hours on the phone chasing solicitors so clients don't have to. And I think so you're also having that extra person that's working for you to, one, get you the best deal, but make sure it goes as smoothly as possible and give you the least amount of headache, going through that process.
Fantastic. I honestly think, Mark, that is a great place to leave it. I think it's a great note to leave on. Thank you very much for coming in today. Is there anything else that you kind of wanted to put out? Are we happy?
No, I think we've covered pretty much everything. I would just like to say, thank you for having me here. It's been an absolute pleasure. I hope everyone at home finds it useful. If anyone's got any questions or want to discuss their mortgages, get in contact with this guy, and between us, we'll help get those questions answered. Fantastic.
Much appreciated, Mark. Guys, if you want to learn about mortgage, if you want consultancies about property, get in touch with me. I'll put you in touch with Mark. We are a 360 service, so we cover buying property, buying second-hand property, buying commercial property, buying off-plan property, helping you with the financing side, as Mark does, helping you with property management, helping you sell your property. So anything that you need to do, residential, buy-to-let, please do get in touch. Cheers, Mark.
Thank you, Stephen.